Hello, everybody. This is Hunter Satterfield, the Chief Investment Officer and one of the partners here at Kane Waters and Associates. This is your August monthly update. As always, I am joined by Brian Bortz, one of my fellow partners and the head of the CWA Investment Committee, as well as Brad Sanders, the Managing Director of Tectonic Advisors. Guys, thanks for joining us. Before we do so, let's look at what happened in the month of August. For the month of August, the S&P 500 was down 1.6%. Global stocks were down 2.9%. Domestic bonds were down 0.6%, and global bonds were down 1.4%. So I think sometimes we get lost a little bit in what this is actually a pretty big move for 1 month. And so, Brad, I'd like to come over to you. And we've obviously seen significant volatility throughout this year. So maybe we look at a month like this with these down numbers that are a little bit bigger than normal and think, oh, that's no big deal because we're used to volatility, but it is, a pretty good little move down. So I'm going to talk a little bit about what happened in the month of August to kind of create this down market that we saw.
I really think it was a number of things, but I think most markedly the market is beginning to believe the Fed. Um, I think the entirety of this year, the Fed's been telling you, "Hey, we're going to keep rates high, and we're going to pause for a long period of time. We're not going to cut rates." And then Silicon Valley Bank happens, and the market prices in like multiple rate cuts by the end of the year, the bond market, and that lifts the equity market. And now where it's in August, and the Fed's probably going to raise again before the end of the year. And so you have those coming out of the market to begin with. And then the market's just tired. I mean, there's a lot to kind of worry about right now for our market to be up 18% in the face of it. We have a strapped consumer. I don't know if anybody's noticed China is in like just a complete meltdown. Nobody it doesn't even make the news though because there's too much going on here. And so you just have plenty out in the markets to cause volatility and in a backdrop that is going to allow for it to probably happen. I'll be shocked if we don't have a pretty volatile fall and winter. It'd be awesome if we didn't, but we're kind of prepared for that to be so. So I really just think that's it, is that the market is starting to realize the Fed's going to be on pause. We think it'll be through the almost the entirety of 2024 before we start getting rate cuts, unless the economy just completely falls apart, which it doesn't look like it's going to, although we are expecting softness and slowness.
That's great. And you actually alluded a little bit to kind of what we're thinking ahead of the fall and the things that we're looking at here internally. And so, Brian, I'd love to come over to you as the head of our investment committee, just sort of getting an understanding a little bit about what types of things are we looking at as we head in towards the end of the year. Brad referenced several of them. I want to talk a little bit about what we're looking at and focusing on.
Yeah, thanks, Hunter. There's still a lot of the same themes that we had been talking about throughout most of the year. There's still a really, really tight group at the top of the market. When you look at, we talk about the S&P and how centralized and focused it is at the top, but the NASDAQ itself, 70% of the NASDAQ return is really tied up in five names in the entire index. So it is very top heavy. We still have an inverted yield curve. Right now, 1-year treasuries are at 5.4%. So, interest rates on the short end are still really high. What we've been more concerned about recently is looking at things like the cost of energy. Oil is up to $87 a barrel now. So energy costs are more, which means it's going to cost more to ship stuff to you when we get to the holidays. People are going to pay more for gas, things like that. And housing costs are up too. So when you think about just the average consumer, and this has been a consumer-driven economy, the average consumer is going to have a little bit less in their pocket right now because they're paying more for gas and stuff around the house. And because of that, savings rates are down. And when people stop saving money and saving rates go down, you end up having a really volatile end of the year. So that's something that we're watching for. I think the Fed is probably not going to do the market any favors in terms of softening. I still have the expectation that just miraculously right before the end of the year, the Fed may change its mind and start dropping a quarter point just to make everybody's statements look better. but right now there's no indication of that. So, investors really need to think about volatility and think about the fact that a long-term plan is not the next 4 months.
Yeah, that's great information, and I think that again, sort of a lot of these things that we've talked about, just of the uncertainty of what's going on, also ahead of an election next year. There's a lot to think about as investors, and sometimes when we start thinking for ourselves, we sort of get wrapped up and tied up in these different ideas. And the reality is that what we continue to tell clients is the most important thing is to continue to invest because we never know what's going to happen in the market. We just continue to invest and trust that the dollars that we're investing are going to continue to rise over time and focus instead more on the long term because of these uncertainties in the short term. There's nothing we can do about those. So instead, focus on the long term, which certainly is something that we can be more confident about in the U.S. economy. So if you want more information, Brad joined us on the Accumulating Wealth podcast last week. That will be hitting shortly. So please join in on that. It's a great conversation that goes deeper into a lot of these topics. Otherwise, we will see you at the end of September. Thank you so much.